a scenario that those of you that have said that the US will inflate away its currency have not considered, you know, and everything, which is that the US defaults on its debt, and then instead of allowing itself to simply be laughed out by everybody in the world when it issues a new currency, it will issue a new currency backed by, a breadbasket of commodities, like gold, silver, and that sort of thing, and everything, because backed by some kind of hard asset, because that would allow them to, restore confidence in the new currency, essentially, and prevent them from being laughed out of the market and everything. And we do have a non-trivial gold stock. We have what's 2.61 at one two 200 sorry 261.49 million 499 million fine troy ounces. The June monetary base was approximately 5.49 trillion. If they tried to make every base dollar fully convertible into the existing gold stock, you know, so gold would need to be revalued to roughly, 21,000 per ounce just to provide 100% backing for the monetary base. That's true, but we probably wouldn't just use it. So basically, what we would do is we would restore credibility after a genuine dollar regime break with a commodity basket that would make more sense than gold alone with diversification. Restoring the gold standard alone would probably be a bad idea. But then, basically after default, a basket that would send, spread the risk around with industrial metals, precious metals, and perhaps agricultural commodities. Historically, economists have proposed a commodity dollars for exactly this reason. Anchoring money to a broad commodity index can, in principle, stabilize purchasing power better than an anchoring to a single metal. Something like this would be conceptually plausible. Gold and silver, copper, and perhaps aluminum slash nickel, oil and natural gas, wheat, corn, and soybeans, and other agricultural components. These weights could be fixed or periodically rebalanced. You'd want them based on economic significance rather than equal weighting, because although otherwise small commodity market could disproportionately move the monetary anchor, the IMF already constructs broad commodity price index uses trade rated baskets. So the physical machinery for defining such a basket is very doable. The important distinction is backed by versus indexed to. So yes, a literal commodity-backed currency means someone can ultimately redeem the currency for physical commodities or legally enforceable claims on them. That's operationally ugly. Oil requires tanks, wheat rods, copper tanks, warehouses, commodities have different grades and delivery points. You also expose the monetary system to storage costs, storage wars, and weather and supply shocks. A commodity index currency is much easier. The government could define, for example, one new dollar equals 0.001 ounce of gold plus 0.002 ounce of copper plus 0.101 blood of oil, and then conduct monetary policy so the market value of the dollar stays close to that basket. You don't necessarily need warehouses containing wheat and oil to redeem every note. The anchor becomes the price of the basket rather than the literal commodity convertibility. That starts looking more like Irvin Fisher's the commodity dollar idea than a traditional gold standard. And I think a crisis or United States might be tempted by a hybrid partial physical backing plus a commodity index target plus hard index rule. For example, the government could put treasury gold, strategic mineral stocks, and perhaps certain commodity claims into an independent reserve authority by requiring that the central bank to maintain the currency's value against a published commodity basket. That would let policymakers say something much stronger than trust us, we promise not to inflate again, to they could essentially say the monetary unit now has an externally observable reference value and issuance is constrained by law. That's the credibility mechanism that you're getting at, but there's one enormous downside. Commodities prices themselves can be very volatile. BIS research points out that the geopolitical disruption, climate effects, and the energy transitions may make commodity shocks more larger and more frequent. If you rigidly tie money to a commodity basket or oil or food shock, could technically force monetary tightening exactly when the economy is already getting hammered. So I doubt that designers would use a naive basket. I'd expect something more sophisticated. Gold, perhaps a large weight because it's durable and liquid doesn't get consumed. Industrial metals, copper slash aluminum, etc., because they reflect real economic activity. Energy included, but probably capped because oil is violently volatile and geopolitically sensitive. Agriculture, probably a relatively small weight because weather shocks are used. Then perhaps the basket would use average moving commodity prices rather than spot prices, so one hurricane or Middle East shock doesn't change the monetary base. That's also an interesting geopolitical angle. A commodity basket dollar would effectively say the value of our money represents a claim on real productive inputs, rather than solely taxing the capacity of the U.S. government. And after an actual treasury restructuring, this might be a much easier story to sell to foreign reserve managers. And unlike a pure gold standard, the U.S. is unusually well positioned for it because it is a gigantic producer of energy, agricultural commodities, and minerals. The country would not be pegging itself entirely to the assets it must import. There's a catch there too, though. A commodity-backed dollar would cause the dollar to behave more like the currencies of commodity exporters. Researchers find strong connections between commodity cycles, exchange rates, and interest rates in commodity-sensitive economies. So you'd be trading one problem, politicians can create unlimited fiat money for another. The monetary system becomes exposed to commodity cycle volatility. In the Pacific disaster scenario we've been discussing, though, that trade may be politically acceptable. If the old dollar had just failed because creditors conclude that Washington couldn't be trusted to preserve its value, credibility would matter more than monetary flexibility for a while. That's why I'm warming substantially to the basket version of your hypothesis. A literal return to dollar, dollar sign X equals Y ounces of gold feels very 19th century. A commodity index new dollar with partial reserves backing and illegally constrained issuance rules sounds more like something policymakers in a postmodern crisis restructuring could actually design. And from our macro watch perspective, there's an interesting implication. If that scenario ever started to becoming more remotely realistic, gold wouldn't necessarily be the only screaming signal. We'd want to watch whether governments begin accumulating strategic metal, energy reserves, and commodity rights and other real assets at the same time that foreign demand for nominal several deteriorates. That would be a much more intriguing constellation of evidence than gold purchases alone. So, my ultimate argument here is that you're not considering the possibility that the US just simply chooses not to pay its debts to its bondholders and then issues a new currency, that is backed by something that we have, in this country, and ready supply, like oil, since we are an oil producing nation at this point, and everything with fracking, and then it would basically, use that and the credibility of that in order to reassure, people that would be spooked at that point, and everything, since credibility would be the most important, at that point after it defaulted on its debts. So this is a scenario you have not considered.